Hi, Lynn Clark here with Remax here in the Houston marketplace. And I just wanted to go quickly to highlight a few things in what I've been seeing. And by the way, this is not all of my information. This is research from top economists in the country and other folks that watch this and get paid to watch this. And it's also based on surveys and good information. So without further ado, I kind of wanted to go through and talk about why we're not headed for a housing bubble. To kind of understand this, let's start with home appreciation since World War II or 1945. There's only been one time in that period, which was basically the 2008 housing crisis, right? Where we had all those bad loans and people having to sell and go through foreclosure and all that stuff. And so as a way of thinking about this, just remember 1945 to 2006, there's never been a dip in price appreciation. It was a self made problem in 2008 that really affected a lot of good families. It was unfortunate that it happened, but we did learn a lot from it, and we are not in the same position as we were back then. So let's talk about that a little bit. So forbearance, monthly number of loans in active forbearance. It's borrowers needing assistance with their mortgage program with the bank. And so if you just look at this graph, you can see, and this is in millions, you can see back in 2020 how many people we had, right? And as we flow to 2022, we're at very low, like 690,000 families right now in active forbearance. So now part of this is because there has been like the government issued like a stop in any active foreclosure activities or anything else like that from the banks. So, obviously that's helped, but that's been removed now for a while. And we're still at the lowest that we've seen it since 2020. That's really good. Now, here's the breakup of what the programs are. So 37% of these outstanding, this is back through March 2022, okay? So a couple months ago, 37% were paid in full. That's that's very encouraging. Nearly 45% were workouts or repayment plans. They worked out payment plans or what have you, and they're just fine. Now, 18% were still kind of in trouble, and that's 18% of 730,000. That's not that big of a number. And if you take a look, you see here, it's 1.3% short sales, deeds in lieu, repayment plans, right? And so if you've been seeing articles in the newspaper that says double digit um, foreclosures, well, you kind of going to see that because, I mean, it's been an all time low. It doesn't take very many for it to come up like that. It's kind of a disingenuous label on this. It's basically what we call clickbait. It's making you want to click on that article to read more about it. But here's the breakout. And based on what we're looking at, forbearance programs are actually looking really good. And so Daniel Hill, chief economist at Realtor.com, says we have learned from history that prices can fall. That's the 2008. But the more important question is if it's going to happen right now. And then he says that's hard to say. And kind of one thing to think about is it's kind of hard to say that it will actually do that, right? So lending standards is nothing like the early 2000s. Default risk is in red. Borrower risk is in orange. And you see this big gap. So this is 99. See how much more product risk? This was just the amount of bad loans that was being written um, to sell these properties. And you can just see that how bad it was leading up to the 2008 crisis. Now look right here. This is basically borrower risk right now. The product risk is non-existent. So we've done a really good job in industry to tighten that up and make that a lot better. So let's look at the foreclosure activity. at an all-time low here. So in red is over a million, and then blue is under. And so here we are, 2005, 2006, boom, we're leading right up to the 2008 fiasco, and you see all these foreclosures, right? And then now in Q2 or Q1 of 2022, you're at 78,000, right? And and where they're coming up with that one article that I saw about double-digit foreclosures, I'm not exactly sure. I'm wondering if there was one month that was greater than the month in the previous year, eh, like by double digits, and so that's what they called it on. But as you look at this graph, foreclosures are actually really a really good rate here. Um, don't want to see any foreclosures, but I mean it's pretty healthy. So lending standards are also tighter. So kind of think about it this way: as a borrower getting funding to purchase a home, um, they prefer the better score to have is above 620, right? And even now, a lot of lenders are wanting 640. Now, according to FHA, as long as you have greater than 580, you can still get a loan. And so this kind of goes through and shows you that leading up to 2008, how many of them were below a 620. And this is in billions, right? That's in billions. That's huge. And then if you kind of tail it through, you'll see that our lending practices are much tighter, making it harder for a person to get the financing, or not harder, but reducing the risk of below 620 credit scores for loans, right? Um, and mortgage debt is not a challenge when it comes to household debt service ratios. So it's basically disposable personal income um, as a percentage of the mortgage household debt ratios. And now these numbers are changing because of inflation with gas and groceries. But even if you include that, you can see where we are today at 3.8%, which is much better than even in 1980. Now we might be getting closer to those 1980 numbers because this was as a couple months ago, but still we're in a good shape, right? Now mortgage payments virtually unaffected. So what does this mean? So the annual mortgage payment for cash out refinances. Imagine you're wanting to do a construction loan and get an updated kitchen, bathrooms, or new roof, or what have you. So you get equity in your home and you refinance, right? So you get cash out and refinance your loan. Back in 2008, from 2005 and 8, the difference in the annual mortgage payment was upwards to $5,000. 2020, 2021, annual difference was like $34, $66, hardly negligible. So people were able to take money out of their equity, do some updates, do some fixes, and do some other things to the home, and refinance and not really incur much of a penalty for that. So what's ahead? Estimated home price performance. So remember the appreciation that we're looking at, and everyone's like, well, are we in a housing boom or bust, bubble about to burst, or what have you? And we look at this, and this is based on the main economic advisors for Freddie Mac, Fannie Mae, the Realtor Association has their economists weighing in the like. And so for 2022, for the rest of the year, we're looking at a 9% overall growth for this year. And that's because inventory levels are still very low and there's still a lot of buyers looking to purchase. Now, please know that this is national. Your specific area might be more or less depending on the economics of where you are at. And if you're interested in Houston and some areas of Houston, reach out, let me know, I'll help you with that. But overall, general, they're expecting around 9%. And for the next few years after that, to 2026, they're looking at the fall back into what's been the typical home appreciation. which is anywhere from 3 to 5%, probably 3.5 being the average. So the cumulative house appreciation, and if you were just to take a look, and this is a forecast for Q1, as of Q1 2022. Hopefully, the next couple of months we'll have this updated for Q2. But if you're a pessimist, like this is the economists that are pessimistic about house appreciation, they still see 10% appreciation between today to 2026. If you're an optimist, you're almost seeing 50% growth. So if your home's worth 200 today, you're looking at 300,000 valuation by 2026. If you just split the difference and use all panelists, you're looking at 25%. So if you're asking yourself a question, should I buy now? Well, what I've been telling everybody is it depends on if you're ready to buy. Timing is basically on who you are as an individual. To put blinders on the market, don't worry about what's going on. You can buy, sell whenever you need to, as long as the time's right for you personally. But if you're just making a financial decision, man, I would lock in as soon as you can so you can get this appreciation, right? So home price forecast for 2022. Remember, we had this 9% average up here, right? But here's all the economists that weighed in, Fannie Mae, Freddie Mac, CoreLogic, NAR, Zelman, UVA. And here's kind of where they all kind of came in. Okay? And this is where we came up with a 9% average. So this is by Bill McBride, author of Calculated Risk blog. Check him out if you'd like to learn more about these type of things. But based on the current estimate for the peak Fed funds rate, 3.25 to 4%, 30-year fixed mortgage will likely peak at between 5 and 5.7. There is some variability in the relationship, so we might see rates as high as the low 6% range. Now, this is important to note that it all depends on inflation and the Fed funds rate, but Bill does not expect rates to move much higher than the current rate, although 6% is possible. I've been seeing for my clients 5.5%. There was a recent change on federal issued loans, and had a client be able to get closer to 4.875%. So if you're wanting to purchase and you don't want to have a interest rate risk of money going higher, the cost of the loan going higher, and you want to get in the market now and get in ahead of that, and also lock in the lower price points and get some of the appreciation for yourself and not for someone else. So affordability. New data from the Harris poll shows 84% of Americans plan to cut back spending as a result of price spikes. More than 70% of respondents said they're feeling the effects of inflation the most in gas prices and groceries. I don't know about you, but I'm living here in Houston, and I'm seeing $4.30 gas prices. That's insane to me. That's hitting the bottom line. And then groceries. All those transportation fees and everything else we're having to pay for. And then you have supply chain issues still. Some stuff you still can't get at the grocery store. This is a big deal. Which I want to say, guys, if you're on a strict budget and you're concerned about purchase and rising rates, you want to buy a home for much lower than what you're thinking. Take a look at your monthly expense and what you want your monthly income to be, and then kind of build in a couple $100 just to help with this inflation stuff. That's kind of the advice I'm giving there. But so this gives you an idea of the cost of interest payments only. Okay, so this is just the interest piece of, principal and interest payments only. Okay, so this is not property taxes, this is not home insurance and the like. And this is based on a $300,000 purchase price. Okay. Back in January of 2021, the average rate was 2.73%, or a monthly payment of $1,221 more principal and interest. Estimated for October 2022 is 5.5% interest rate at $1,700 a month. This is nearly $500 more than January 2021, a year and a half later. This so just going from current 5.3 to 5.5, you're looking at, oh, is it $43 more? So guys, if you can get into a home, you want to get in a home, save that $43 a month. That's a month. That's like $600 a year difference in payments. So here we are at the affordability approaching. So the higher the bar equals more affordable. Okay. And as you can see, we're starting to approach and get to kind of where we've been since 1990 to 2018. Or I'm sorry, 2008. The affordability is going down because of these rapid appreciations that we've been seeing the last couple of years in the housing shortage. So we're kind of getting more into that phase, but we're still looking at a pretty good average. Okay, so this is still a good time to buy, especially if you can get a good rate and lock in those lower appreciations. Okay, so the average consumer is spending an additional $429 monthly for items other than shelter. Meanwhile, average weekly wages rose just $212 per month, so the consumer is short by $217 per month. This means that the average consumer will be looking for a home that is basically $42,000 cheaper. So if you were looking at a home at the beginning of the year at 300, your price point might need to be closer to 260. And I know I've seen that happen to several of my clients as we're guiding them through and trying to make this expectations of higher inflation numbers and costs at the pump and grocery store. Um, One client in particular, we actually moved her from 325 to 225 just so that we were on the safe side. And at that lower price point in this market, it's a little bit harder to be able to get into a home. It's more competitive. We're getting it done, but just kind of think about these things. If you're on the fence and you're wondering, should I wait or should I not? The answer to that question is that if you really need housing, just go now. Don't wait. Go now. If you have a good place to live and you're secure and all that stuff, and you want to wait a little bit, and timing's not perfect for you, go ahead and wait. Don't be surprised if it's above 6% interest rate and the home prices go up another 10%. That's just the cost of waiting. But perhaps inventory levels will be back to normal and you might be able to work out a better deal. That's the question mark, right? And only you can answer that, but that's kind of what I've been letting my clients know, or letting them, advice anyways. So, do I have a relevant market opinion based upon facts? So, I want you all to stay tuned. Summer buyer and seller guides I will have in June of 2022. So, if you are looking for an update, it's going to be next month. I'll have these buyer seller guides for you. So, just if you see this, just reach out. You can request that. Just make sure I get your email address and I can email it to you. If you want to stay current with what I am doing and everything else like that and get on this type of monthly call, you can always go to my website, lynlclark.com, register, and send me a note that you'd like to get added to this monthly newsletter where I kind of go through what's going on in the marketplace. All right. Well, I hope that this finds you well, that you're having a fantastic, wonderful Wednesday. And I want you guys to go on and just have a fantastic rest of your week. If you have kids that are graduating, congratulations. If you have kids going to college, oh no, good luck with all that. I am about 4 years behind you. All right. God bless, guys. Bye.